So many investors today, myself included, have been so trained by the last 20 years to think of a credit environment as only at its most attractive point when there's a liquidity crisis. That doesn't necessarily have to be the case, and that isn't really how we see this cycle or this episode playing out. We look at the market today and say, if we have the ability to make equity-like returns while making credit investments, whether that's in loans or securities, in primary or in secondary, in performing companies or stressed companies, if we can make those types of investments at equity-like returns without taking what we think is equity-like risk, well, we don't necessarily view it as one must wait for that global margin call or for that global liquidity crisis that may or may not arrive. If we look at today's set of facts in terms of is it a good time to invest in credit today, we like to compare to where we were before inflation, before interest rates, before central banking policy came to dominate the narrative. The world we live in today, where interest rates are substantially higher, credit spreads are substantially wider, and suddenly we're in a world where all types of credit investing that was offering 4, 5, 6, 7, 8% returns is suddenly offering mid-teens returns. Every investment we look at has a risk and has a reward. And when we start on the risk side of that analysis, in today's world where the range of outcomes is so wide, we can't predict what's going to occur. So we want to focus on investments where wherever those facts land, we feel our investment is protected. The exciting part of today's environment is that we can take investments that we think have that low risk profile, that are less vulnerable to these variables of inflation, rates, central bank policy, recession or no recession, but be able to make returns that are equity-like in nature.